everybody. Luke Groman, founder and president of FFTT, Forest for the Trees. Hope everyone had a great weekend. Happy Sunday night to you. Just wanted to run through the two things that grabbed my attention recently. Quickly here, we're going to jump right in. Of course, would be remiss not to mention yesterday's headline. President Trump says the dollar is too strong. He was right about the Fed rate hikes last fall. He's right about this. The question is what does it mean, if anything? And I think it was important to notice something retweeted last week, which was a White House transcript between Treasury Secretary Mnuchin and Robert Lighthizer, where they said there's no agreement on anything until there's an agreement on everything, and they said it would be one of the strongest FX deals that they've ever had. We've spent a lot of time on currency and it will be enforceable, is the quote. And so mechanically, completely understand why the dollar should continue to rise or be strong. We talked about this last week in our Macro Voices interview. That said, the secular strong dollar crowd is just completely ignoring the possibility of some type of trade deal. And so we're not factoring in ourselves, but we're just watching it and saying, hey, they're talking about it, and so let's watch it from here. Second thing that grabbed my attention this week was the headline on Reuters that Saudi Arabia's crude oil exports to China running up running at about 1.5 million barrels per day in the first quarter. That's up for roughly 50% quarter on quarter. To me, I thought this was a very potential important clue. We know that China and Saudi signed a big deal late last year to significantly increase Chinese imports of Saudi crude by 60 to 80%. We know that at least 2 or 3 of China's top 5 suppliers are at least willing to supply in yuan. And we know that China has a dollar shortage. And so the question becomes, why would China displace their largest supplier, Russia, who is a willing yuan supplier, with a dollar supplier, Saudi? And there's only 2 possible explanations for that in our view. Number one, China is stupid and basically making their position worse by making themselves more short dollars in a dollar shortage in a key negotiation with the U.S. Or option number 2 is Saudi has already granted China some level of flexibility on currency vis-a-vis oil sales to China. That's what we think it is for a whole number of reasons, but I thought those 2 things were really interesting. I'm going to jump into a couple quick questions here that we got in regards to last week's before we jump into any questions you guys might have this week. So first off, thoughts on the investigation into the gold-silver fix. This is from Tom. Have seen zero press coverage of this, wondering how this fits into your views. And Tom, thank you very much for sending me a couple of the PDFs as well. I hadn't seen those, but have been tangentially aware of some of the ongoing investigations into this stuff. What I would tell you is that we have said in a number of our different interviews that the gold market hasn't been a real market since at least 2013, and that it won't be a real market again until it is, and we'll all know what it is. And I would leave it at that. These some of the documents you sent, public documents, were, I think, indicative of that view. Ultimately, it's important to remember that gold, in particular, to a lesser extent silver, gold is a political metal, and so it feeds into this view that it hasn't been a real market since 2013, and likely won't be until it is again, and then it might be pretty binary when it stops being so. From Patrick, things getting down here in Australia regarding housing. Question is regarding my contribution to Macro Voices. Thank you very much for the kind words. Asking, was slightly disturbed when you stated the reset could be non-linear, i.e. S&P 2700 to 1900 to 4000. And the reason for that, he's asking for the reason for that, and it's the dollar ultimately. As you would see the dollar weaken notably, and markets would readjust to that very quickly, if not binarily. I think, quite frankly, what we've seen in the last 2 months is merely indicative of how fast that can happen. We had a whoosh down, and now we're pretty much right back where we were right before that whoosh. It took 2 months. I think it could happen even faster. But basically, if you're investing on a quarterly basis, the way things fell this time, it showed up in your quarterly report. But had the months been slid 1 month back, if December ended in November and we had the whoosh down in December and then the bounce back in January and February, it was like it had never existed. So that's why I think that's the case. And then one last question. Let me see. Do we think reason has left financial markets if the Fed is basically backstopping markets or has become their third mandate? I don't think it's left markets, but I think the runway on the Fed's ability, or the fact that the Fed is, I thought with some of their commentary, kind of confirming what myself and some other colleagues of mine that I talked to in markets have thought, which is that the Fed has an unspoken third mandate, which is the stock market. And there's been much over the last 10, 15 years in particular to support that. They would never say that in my view, but they don't need to. So ultimately, though, remember capital structure 101. You've got a bond market that doesn't care about the story. Bond market cares about their coupon arriving at the proper time. And so ultimately, if there's a problem in the bond market, it'll be reflected in the stock market. But that's kind of how we're thinking about that. So let's see here. Let me see. We're going to jump in here. Some other questions. Sorry. We're trying to get it to. Okay. Main indicators to follow if we move to QE4 or MMT. Hi, Juan. Great question. I guess if we're going to move into QE4 or MMT, I think I'm watching the broad macro data series. I think a big one that continues to be underfollowed are U.S. tax receipts. They're down slightly right now, so that is one that I think is very noteworthy to watch. But I think it's ultimately sort of the broader economic data series that we're seeing slow pretty notably, both in the U.S. and abroad. Let me see. Implication of China's current account deficit, especially considering 50% oil use increase. This it touches on a number of. This is a key crux of something we talked about 6 months ago at our Macro Voices presentation. We've talked about it some other times since. It is a matter of national security for China to be able to price commodities, in particular oil, in yuan. If they cannot do so, the increased imports of higher cost oil will put them into a current account deficit position. It will cause a balance of payments problem. It will cause a yuan crisis. It's a great segue into the next question from Jeremy. Hi, Jeremy. What did I think of Kyle Bass's interview on Real Vision? I thought it was an excellent interview. I thought two things grabbed me. Number one, for the first time on Real Vision, Kyle has addressed that China is attempting to get the Saudis to price oil in yuan. He noted that a lower price of oil buys China time on their current account, and did so in a big way in the fourth quarter. He downplays Saudi's likelihood of selling oil in yuan. I think he is. I don't think he's giving that enough credence for several different reasons. We'll say the bottom line is it's a matter of national security for China to price oil in yuan. They are making strides in doing so, and so I think ultimately, if China can gain the ability to increase the percentage of their imports that they are paying for in their own currency, a lot of the math, Kyle talked about the IMF reserve adequacy math that they laid out to China in 2015 and 2016. The IMF did, and Kyle's right about that math. But if China can print yuan for commodity imports, that math's irrelevant. It's completely and totally irrelevant. Because China has a commodity imports a $700 billion non-commodity goods surplus, and so basically that surplus is being masked now by commodity imports. That surplus would cease to be masked if all those commodities were priced in yuan, and so to me, it's why the yuan oil contract has the potential to be such an enormous game changer. Let's see. Marcus, saw Kyle Bass on Real Vision. Do you expect a China deval? What does that mean for the trilemma and gold? I don't expect a China deval. I think you're going to stay in this range, and I think it's going to bore the heck out of people because it appears to me that China has effectively tied physical gold flows to the yuan dollar valuation. In other words, if you look, every time the yuan dollar has neared 7 over the last 3 years, London has just begun hemorrhaging, absolutely hemorrhaging gold, 80 to 100 tons a month. They can't lose that much tonnage for very many months. And I would assume that that rate would accelerate if we actually broke 7, 7.5, 8. So basically, it looks like you have a Mexican standoff where if the yuan dollar goes below or goes above 7, you may see London cleaned out of gold even more rapidly, and that would have I would think if London or New York said we're out of gold, on a force majeure over a weekend, gold would be repriced an order of magnitude higher. China would certainly probably have a say in where that would be priced, and my guess is those prices would not be dollar positive. Let me see. Hi, Mike. Do you think there will be an outright dollar devaluation as part of the present Chinese talks? I'd be surprised if it was binary, only because you need to kind of phase it in so that you can give markets a chance to adjust on the dollar side. I don't know that you. That said, if the dollar did get marked down binarily, it'd be a huge positive for markets. Huge positive. Because again, everybody's short dollars. If the dollar goes down, that's the other way you can cover your dollar short, and you cover it profitably. So they're clearly, in my opinion, I think there's a lot to say that there's a lot to suggest they're talking about the dollar. The fact that Treasury is involved in a trade negotiation should have been a huge clue to, I think, many people all along that the dollar and that exchange rates are being discussed. But I think I don't think they're going to get a deal like you got with Japan in the 80s, the Plaza Accord, where we basically said you're going to lower the value or you're going to raise the value of your currency. Thank you for playing. China's not Japan for a whole number of reasons. And so I think there has to be a quid pro quo. So maybe it is, look, we will strengthen our currency and you will allow us to buy oil from the Saudis in our own currency. That might be a deal you could see happen. Let me see. Thoughts on GDX or mining stocks? Hi, Trueheart. Yeah, I think ultimately they should stand to benefit, but it's one where I think you need to make sure of the jurisdictions and the legal rights of the assets in place under the ground for each company. Let me see. Hi, Super Bubble. Apart from gold and history books, what assets are undervalued? I think there's probably I've had a couple different small business prospects or where they're just maybe under the radar, but private businesses that are doing really well. But I don't know that when I look at the public markets, I don't see a whole lot where I say, gosh, they're really undervalued. Because it's really dependent on a macro outcome. If the dollar weakens, everything's undervalued. If the dollar doesn't weaken, nothing's undervalued. And so it's to me, when you look at the list of assets, I think it's a pretty short list at this point. Will the trade deal success help stocks jump? If they get a real trade deal, I think it will be very positive. That said. In the short term. That said, I continue to be skeptical that they are going to be able to get a very substantive deal done. Not just because they've been saying they're going to get one done for 5 months, 12 months, whatever it is. But again, the ask of each, a core crux of the ask of each side is a matter of national security for the other side not to grant. And so I just... you may get some hurrah on a trade deal announcement, but I'll be looking at it very skeptically in terms of whether it's a real deal and what the terms are to it. The caveat I would attach to that is if you come in, we get a trade deal, and we see the dollar trade down 30 to 50 cents a day for 2-3 weeks, that I think to me would be very substantial, very important. Let me see. Do I think the yield curve is on the cusp of a cyclical upturn, perhaps Fed engineered? In terms of re-steepening, it's interesting. I was giving some thought to this actually. Some stuff I was looking at tonight. The stock market effectively is the U.S. economy, and so I think the U.S. economic data is going to get better in the next couple months. Right now we're seeing punk data from December when we had the worst December in 87 years. Punk retail sales, punk housing sales, punk housing prices. But we've seen this huge bounce. And so my guess is you'll see better sales. And so my guess is you could see, I don't know if the Fed engineered or not, unless you want to make the case that the Fed's engineering the markets, and that's a rabbit hole I don't want to go down. But the bottom line is the equity market effectively is the economy on the consumption side in particular, and it's very important to tax receipts, particularly on marginal dollar basis. So I think you're going to see better data. I think if you see better data, then you're going to see the long end continue to back up. Bitcoin. I know you. Yeah. There you go. I said it, Thibault. How are you? I did say Bitcoin. To me, it's just the market there. With this cash settled futures market, it has just not traded well ever since that market launched a year ago, and it continues to not trade well. Let me see. One last couple questions here. No possible Plaza FX agreement type outcome. I think it is possible, but I just think it's very unlikely because you're gonna if China's not going to do it without with sort of Japan-like terms, which was again I mean, think about it. We had our military in Japan. We effectively then and still do provide much of Japan's defense for them. We had a lot of leverage. We don't have that kind of leverage there with China. And so I don't think there's going to be that kind of a deal where we show up at the table and we dictate to China how it's going to go. There's going to have to be a quid pro quo. Now, the issue there is, like I said, could it be something with yuan, oil with the Saudis, or could it be there's going to be some other quid pro quo there? And the challenge with that is that it's a headline win, but ultimately it creates some continued it doesn't do anything to fix our funding problems unless it really really weakens the dollar, and so those funding problems ultimately are going to continue to crowd out the U.S. economy. So. Let me see. Do I agree with Kyle Bass's political populist anti-China views? I'm gonna pass on that one for the moment. Look, the thing that grabs me about the sudden interest in China IP theft is two things. Look, this isn't a surprise to anybody. Whether you worked on a line in a factory, whether you're a manager in a factory, whether you're an exec with a company, whether you're a politician, this hasn't been a surprise to anybody for 15 years. So why now? And the reality is that it's very curious to me that ever since the Chinese stopped buying treasury bonds, all of a sudden people care about this. So that's one. The other thing here too is I would say that's probably the biggest. That's probably the biggest. Is I'm just there's a lack of a other side, right? Which is they're stealing our IP. Okay, great, they're right. But China's side of the story is you printed $5 trillion of the reserve asset to bail yourself out when you've made everybody else in the world take pain when they did what you did to your banking system. And so basically you stole our wealth when you did QE, which is different than what you did for everybody else. So you've got the U.S. saying you're stealing our IP. There's some truth to that, a lot of truth to it. But the problem is the other side's right too. We did steal there. That was it. That's why we recovered faster. We stole everybody's purchasing power with the dollar, and now we're weaponizing it. And so, I'm not sympathizing with China. All I'm saying is I take a very realpolitik view of all this, and I think Kyle's views are very one-sided. And not appreciative of the broader picture of and I keep saying this on Twitter, which is if you want to fix the trade situation, you got to fix the currency situation, because everyone in the world knows they just voluntarily give in. They'll go the way of the USSR. They'll go the way of Southeast Asia in the late 90s. They'll go the way of Argentina. So I am going to jump with that. I apologize for any questions I didn't get to, but hopefully everyone has a great week, and I look forward to catching up with all of you guys again next Sunday night. Have a great week, guys. Take care.